The Dow is off 9.2% from the 2010 closing high at the end of April. Our next guest says this could get even worse. Charles Nenner, the founder and president of Charles Nenner Research, joins us live for more. So how much worse, Charles?
Well, how much worse? I mentioned a few weeks ago on CNBC that my target was 5,000. What actually happened is Mr. Prechter, who was very inventive in the Elliott wave, came up with the level of 1,000, and then I was asked what is my level, and I calculated 5,000. It's not so far away. First of all, I want to mention something classical that everybody knows. If you look at the American stock markets for the last 100 years, then you know that the market appreciates like in the average of 8-9% a year on the long term. So you can draw a line with an angle of 8-9%. Now the problem started to be in the 80s, 90s, that we saw the markets appreciate much more than at 8-9%. So we're much above the level, and even after the several crashes we've seen, we're much above that line. Now that line at this moment would be just below 7,000. So 7,000 would just go back to the medium situation. What I do is I did this 12 years for Goldman Sachs. My models have a certain algorithm that can calculate exactly what happens and when it happens. And if I project from the last low in February 2009, I get down to 5,000 on the next down move.
Is the next down move slow and steady, or is it flash crash-esque? We also have a question in for you from a viewer who wants to know if this M&A activity is also going to predict more of a tightening in markets.
That's a question that I don't feel I'm capable of answering. I want to explain that what I do is I build models that explain what is going to happen and when it's going to happen up to the exact day, but I leave the reasons why. I leave it for other people to make interpretations because I don't think it has anything to do with reality. It's very hard to understand how this is working, but if it depended on what kind of news would come out any week, then I could not predict the future.
Okay, well, let's have a look at another market then with that in mind, Charles. Let's look at the bond markets, because I know that you're saying that we're going to see some kind of downturn in the next few months to come, but then people should be going long after that. Is that the case? You're going to see a continued, essentially a medium-term call being a continued surge in bond prices.
Right. What happened was that a couple of months ago, when the S&P hit our upside target around 1,200, that was the end of April, there was at a time when bonds were 4%, and then went totally out of stocks, totally in bonds with 4%. And I said, we will see in a couple of years how happy we are getting 4%. So we're staying in for the 4%. What is going to be is, my cycle showed that there is some pressure now that we can see for a couple of months, but then the yield should go lower for the next 3-4 years again.
Hey Charles, in this time of volatility, risk aversion, are you a long-term bull on gold and silver?
You exactly say that correctly. A long-term bull on gold and silver. We sold the gold at 12.25. That was the end of December, because my cycle showed not much was going on. And by the end of the year, we expect to start a new bull leg, and we're bullish on gold and silver. That's correct.
At a time like this, we're also focusing on the yen right now. A lot of people are saying the yen could actually go to 77 to the dollar, given all this jawboning we're seeing from the Japanese authorities and no intervention whatsoever. Are you long on the Japanese yen as well?
Yeah, we're long on the Japanese yen, and my target is 80. I don't believe anymore really in interventions, because the markets are so huge. I don't see central banks having enough money to do interventions like they did 20 years ago.
So all of what you're saying seems to suggest a pretty gloomy picture then, Charles. But I see from your notes that you don't buy into a dollar bull argument. You see dollar weakness overall. That kind of runs counterintuitive to the other trends that you've been talking about, does it? I mean, at times of stress, people often buy the dollar.
I have to think about that. It's a good question. Again, what I do is I follow my models. I can make a case for that there will be more easing from the Fed, and the real interest rates, that mean, take interest rates, you look at the inflation, which I think will turn into deflation. For instance, the real interest rates in Japan then even look better in the United States. So then there's a fundamental case that you can make that the dollar should go lower.
So, Charles, we talked about you predicting the Dow at 5,000. If we could pull up a chart that you put together on ExxonMobil as well, you say that this is a good buying opportunity. Why? A lot of people are talking about oil as a possible hedge for treasuries these days.
Well, first of all, ExxonMobil is one of the stocks that hasn't done anything this year. We have been short on that stock the whole year. Now, what you see on this chart is a printout of the work I do, and on top you see the stock price of ExxonMobil, and below that you see what my model shows. So my model shows the tops and the bottoms, long-term, short-term, for anything you put in there. So in this case it's ExxonMobil, and I just want to show that there are some possibilities of still making money, although we're not crazy about the market. And one of the things to look at is oil stocks, and especially ExxonMobil. As you see where the red line is, on the bottom you see that that's what the cycle low shows where you should go in. Now that low is only by the end of the year, but then you see there's a very nice run and up move for a couple of years. So we have a couple of stocks that we're watching, and we just wait till the cycle bottoms and then we get in there, especially because with the low interest rates the dividend is still paying a nice amount of money.
All right, is Exxon a lone wolf in the sector?
No. We made a list of stocks we like that we still want to buy, but we only go according to the model. So when the model says the stock is still down, we wait for the cycle to bottom, and when the bottom is there, we go long.
All right, let's take a look at some of your unemployment forecasts, your non-farm payrolls forecasts as well. What are you predicting in the future here? There is also some speculation that this M&A activity could contract, hiring even more, which is the last thing we need. Well,
again, I have to explain a little bit my work. My work predicts what happens, and it's not connected what happens in politics or who is which party is in power. The idea is that things don't move at random and they're predictable. So here we built the same cycle. We just did it on unemployment, as you see, and it's not so bad. We see that in a couple of months. I think it's in April 2011. We see for the moment a high in unemployment. So we still have a couple of months, but then it should look a little bit better.
And Charles, looking at European equity markets, you brought in a chart of the Amsterdam stock market. Is that because this is a particularly interesting case, or is it just an example of other European equities?
I tell you, at the moment I'm based in Amsterdam, so I look a little bit at Amsterdam. It's just, you see, I believe that if markets go down, all markets go down. I don't believe, first of all, one market stays up. I don't look for finding that one stock that stays up when markets go down. So I just took a print of the Amsterdam Exchange, and this is a daily cycle. So it's a bit short term. And what you see is the cycles, they turned over, they rolled over, and this is an example of all the markets in Europe actually. So they're slowly grinding down.
And just really quickly before we let you go, do you have a white paper for this? A viewer wants to know, Park writing in. Can they see your research somewhere?
Oh yes, if you go to Google and you put in Charles Nenner, then you get to Charles Nenner Research Center, and if you say you like to see the research, we always send the trial out for a couple of months, and the research proves itself.